Hello there. I hope that you are doing well. Welcome to episode 2 of the Zeussy 2025 public mentorship on YouTube. During this episode, I will be discussing institutional order flow with you. If you did not watch the first episode yet, I highly suggest you to watch that episode first. Market structure as understood by the masses. In front of you, you can see a screenshot of how the majority of traders out there are looking at market structure. If bullish, they are looking at the markets to make higher highs, higher lows, higher highs, higher lows, etc. And that is a process which repeats itself infinitely. When bearish, they are looking for lower lows, lower highs, lower lows, lower highs, lower lows, lower highs, etc. And the reason why the masses are looking at market structure this way is because this is the easiest way of defining swing points within the markets. However, I want to ask you something. If you have ever tried to look at the markets through this lens, how many times did you see the following occur? Where you saw the market create a lower low whilst you were anticipating a higher low, and you were taught that this would be a market structure shift break, the market takes you out by running below that low where you had your stop loss placed, and then all of a sudden it begins to run higher. And if bearish, for example, you were looking at lower prices, you saw the market run lower, we formed this high, we formed a lower low, so now you're anticipating a lower high. But what occurs is that the market reprices above that high, right here, it creates a higher high, and then it gets labeled as a market structure shift break. And then all of a sudden you get taken out and then the real move occurs. This right here is the issue with the perspective on market structure as understood by the majority of traders out there. And the reason why this is a big issue is due to the fact that this is simply a too simplistic approach to looking at the markets. Meaning, there must be an underlying logic behind why a certain lower high should remain intact within the one-sided order flow which is present. And that is where institutional order flow comes in place in order to fill in that gap. It comes in to fill in the gap behind why a certain lower high should remain intact. And that is what I will be explaining during today's lecture. Institutional order flow. Institutional order flow, or IOF, shows to you in what direction the market is being repriced. Notice I'm saying it shows to you in what direction the market is being repriced. I am not saying to you that you can see in what direction the market is being bought or sold. There's a big difference there. Bullish institutional order flow shows to you that the market is being repriced higher. Bearish institutional order flow shows to you that the market is being repriced lower. Now, before we dive into how to define bullish and bearish institutional order flow, we must first take a side jump towards premium and discount arrays. Premium and discount arrays are algorithmic signatures that show what algorithms are currently doing in the market. I will share with you the most important PD arrays to focus on to determine the institutional order flow. Meaning, I will not share with you the full PD array list as created by the inner circle trader Michael J. Huddleston. I have selected a few which I will be explaining during this lecture because they are the most important for being able to gauge or determine the order flow. The first PD array which we're going to take a look at is the fair value gap. The fair value gap can be seen on the left of my screen where you can see these three candles right here. Notice that there is a difference between the high of the first candle and the low of the third candle. Let me explain. You can see that this first candle expanded higher. The second candle also expanded higher and it expanded through the high of the first candle. The third candle then opened up, went lower for a bit, but it didn't go as low as the price level at which the high of the first candle formed. Therefore, there is a lack of sell-side delivery inside of the range between the high of the first candle and the low of the third candle. Therefore, there's a lack of sell-side delivery which has taken place inside of the price range which is annotated by this gray box. What IPTA has to do, it has to retrace back into that price range, it has to offer sell-side, and once the market reprices away from this bullish fair value gap, that's when the price range has become balanced. but that's a topic for another time later during the mentorship. But for now, this is what a bullish fair value gap looks like, where you can see that there's a difference between the first candle's high and the third candle's low. Here you can see that I've also added the bearish fair value gap schematic on the right. The bearish fair value gap is exactly the opposite of the bullish fair value gap on the left. Meaning on the right you can see 3 red candles, and these red candles represent down close candles. These down close candles make up one fair value gap. And to specify, these 3 down close candles make up one fair value gap. And the reason why this is the case is due to the following. What I want you to see is that there is a difference between the first candle's low and the third candle's high. There's a lack of buy-side delivery which took place inside of this range. Therefore, IPTA has to reprice back into this price range of this fair value gap to offer buy-side into that range. And the moment that price does that, we can anticipate that when price expands away from that fair value gap, that this range is now balanced and that we can anticipate further continuation lower taking place. Therefore, pay attention to these fair value gaps which form in bearish markets to gauge the order flow. Now, before we move on to the next slide, I want you to understand that the schematics which are in front of you are perfect examples of what these fair value gaps look like. And therefore, I highly suggest you to make screenshots of these schematics and put them in your study journal, because this is how you recognize patterns within price action. You pay attention to what the pattern looks like, and then you begin looking for it actively within your charts. When we pay attention to the next PD array then, it's going to be the breaker which we're going to be looking at. The breaker looks like the following, where you can see that the market forms a low, high, lower low relative to this low, and we then see a higher high form, and we then pay attention to the up close candle which formed inside of this high formation before the market had this final run lower. Let me repeat that. The bullish breaker is the up close candle which formed inside of this high formation before the market had its final push lower. The moment that the market displaces above that high, we pay attention to this up close candle and we extend that to the right. This up close candle is our bullish breaker, and we anticipate that that bullish breaker is going to function as support on price before the market is allowed to be repriced higher. The bearish breaker looks exactly the opposing again, where you can see that the market expands higher, it forms this high, we then see the market form a low, a higher high forms, and we then see the market form a lower low relative to this low. The last down close candle, which formed inside of this low formation before the market expanded higher for the final time, that down close candle is our bearish breaker. Meaning we can anticipate that that down close candle in its respective price range is going to function as resistance on price now that price has displaced through it. Meaning we can anticipate a retracement higher into that range before further continuation takes place. Now, when we pay attention to the breaker schematic, what I want you to investigate is whether or not imbalances line up with these breakers. The next schematic which we're taking a look at is called the mitigation block. The mitigation block looks exactly the same as the breaker, but there's just one exception, and that's the following. What I want you to see is that the market expands lower, we form this low, the market retraces, and we form a high, and the market has one more push lower, but notice that the previous low which formed does not get taken out. Instead, we see a higher low form, and the market displaces higher. We see a retracement taking place into what? Into the last up close candle, which set up this run lower, which set up the creation of the higher low. That up close candle is our bullish mitigation block and has to function as support on price in order for continuation higher to occur. When we pay attention to the bearish mitigation block, you can see that's exactly the opposite of the bullish mitigation block, where you can see that the market expands higher, we form this high, we see the market drop lower suddenly, a new low forms, then the market has one more push higher, but notice that the market does not create a higher high relative to this high. Instead, a lower high gets created. The market then displaces below the low, which set up this push higher, and we then anticipate that this final down close candle is going to function as resistance on price The reason why is because this is our bearish mitigation block. Now, what I want you to understand when looking at these schematics is that these schematics are simply schematics that showcase to you a certain logic. And the logic which is being shown to you is that the market has to retrace into specific levels before it's allowed to continue towards the downside. What I want to invite you to study is with regards to every single reversal that takes place in the market, whether or not there are any reversals that do not contain a breaker or a mitigation block. And that is going to be a fun study. And let me warn you, you are not going to find any examples of there not being a mitigation or breaker block being in play, because every single reversal contains a mitigation or a breaker block. And that is a very fun study for you to do. And next to that, I invite you to investigate whether or not imbalances are forming close to the breakers and mitigation blocks. Let us now take a look again at institutional order flow now that we have discussed the PD race. We're first going to take a look at bullish institutional order flow. Bullish institutional order flow shows to you that the market is being repriced higher. Bullish institutional order flow can be recognized by seeing discount arrays function as support on price and premium arrays failing to function as resistance on price. However, I want you to be aware of the following statement when it comes to all of these price patterns. Price is of no use until it is aligned with time. Meaning, until time is right, all these price patterns means absolutely nothing. And this is a statement which I will be discussing later during this mentorship more in depth. I'm first explaining price to you before I can dive into time. Let us take a look at a chart example. Here we can see a chart example of bullish institutional order flow being in play. What I've done is I've already marked up the chart before showcasing it to you. The reason why I'm doing so is because I want to explain to you the application of recognizing these PD arrays within the charts so that you can then investigate your own charts and look for these PD arrays to form. During future lectures, I will not annotate the charts as in detail as I did now before I showcase the chart in the first place. And I will invite you to investigate the chart before I put on my lipstick. But for this first chart which I'm sharing, I've decided to put the lipstick on. So what I want you to see is the following. What I want you to see is that the market was in a sell program. I want you to see that the market was dropping lower, and you can see that it was repriced towards the downside. Notice that during this run lower, this imbalance right here formed. There was a lack of buy side delivery between these three candles, between candle 1, candle 2, and candle 3. Notice that candle 3 did not create a high in close proximity to the low of the first candle. And therefore, you know that this is a CB. This is a bearish fair value gap. We see the market then drop lower. We see a low form and a retracement higher takes place. This retracement higher has one function, and that is to trap people into believing that the low is in. The market drops lower one more time, and during this sudden drop lower, you see a CB form. A CB is referred to as a bearish fair value gap. A bullish fair value gap is referred to as a BC, and that is something for your notes. The price patterns are exactly the same, but this is just a terminology thing. What we can see is that the market eventually forms a low, and it then displaces through this blue box, through the price range of this CB, through the price range of this bearish fair value gap. Notice that we reprice above it, and the fair value gap then begins to function as support on price. This right here is a premium array on the left side of the curve, functioning as support on the right side of the curve. And remember what I outlined to you when it came to bullish order flow. Let us go back one slide. Bullish institutional order flow can be recognized by seeing discount arrays function as support on price and premium arrays failing to function as resistance on price. If the market would have continued to be bearish, it would have utilized this CBS resistance on price to draw lower. But the fact that it didn't is already IPDA tipping its hand to you that a change in the state of delivery might be taking place soon, where the market is changing from sell program, where it is drawn towards sell side liquidity, to buy program, where it's drawn towards buy side liquidity. However, if you want to wait for more confirmation, what do you wait for? You wait for this upclose candle is high to get this place through, because this upclose candle is your bullish breaker, where you saw a low, high, lower low, high, high. Therefore, you anticipate that this upclose candle is going to function as support on price if we're in fact going to see higher prices taking place soon. Notice that we repriced outside of the range of that upclose candle with this bullish fair value gap, with this BC. Notice that the market spent some time inside of this blue shaded box, which was that CB which I had outlined prior. And notice that when we closed above it, we retraced back into the lower end of that price range, back into that BC, formed a new low before the market began expanding towards the upside. Notice that every single bullish fair value gap, such as here, which formed, and here, functioned as support on price until the drawing liquidity of this buy-side liquidity pool above this high was reached. Notice that the market retraced into this bullish fair value gap and then expanded higher, creating a new bullish fair value gap. The market retraced into that range before expanding higher. Now, I will teach you later how to establish the point of interest and drawing liquidity, but for now, I simply want you to investigate liquidity and these PD arrays in order to gauge the order flow, in order to determine what side the market is likely going to draw towards. This is the example of bullish institutional order flow done, where you can see that the premium raise which formed on the left side of the curve failed to function as resistance on price, and therefore we can anticipate that the underlying order flow is changing from sell program to buy program. Now, before we continue with this lecture, I don't know exactly how many minutes we're in right now, but I hope that you're paying attention to the level of detail in my explanations. Because it is the order or the so-called sequence that I utilize to explain what I'm explaining to you that matters. It's the sequence of events that lead to the next events taking place. Because when you can recognize the sequence which is currently taking place, you can logically anticipate what the next function of IPDA is likely going to be. Let us now take a look at bearish institutional order flow. Bearish institutional order flow shows to you that the market is being repriced lower. Bearish institutional order flow can be recognized by seeing premium raise function as resistance on price and discount arrays failing to function as support on price. Again, price is of no use until it is aligned with time, meaning keep in mind that the price patterns of PD arrays mean absolutely nothing until it is aligned with time. And that is again something which we're going to discuss later, way more in depth within this mentorship. But for now, function on these PD arrays and the sequence in which I'm explaining them to you. Here we can see a chart example of the bearish market, where you can see that I've already annotated the chart and I'm going to walk you through it. What you can see here on the left is that since 8 o'clock, the market was in a rush to run higher. Notice that there was a lot of back and forth going, however, during this run higher. 8:30 opens up and we see the market continue this rush to reprice higher. Notice again, however, that there is a lot of chop, as I commonly refer to it, where you can see just this back and forth price action, and it's very messy, it's very ugly. But that right there is exactly what we're looking for on the left side of the curve. And the reason why we're looking for that is because every single retail-minded trader is looking at this repricing higher and they're thinking to themselves, oh, this is a bullish market. We should be buying this market. So what they do is they chase price and they place their stop losses below any of the swing lows which form. They can draw up trend lines that are diagonal and they can draw those trend lines higher like this, and they think the repricing higher is just going to continue forever, right? However, what do you see? You see that multiple fair value gaps get created during this run higher, and eventually you begin to see these fair value gaps get overrun. Where you can see that this BC, this bullish fair value gap, failed to function as support on price. You saw the market tap into it multiple times, but eventually you saw the market close below it with this candle. Notice that the next candle opens up, reprices higher back into the price range of that bullish fair value gap, of that blue shaded box, and it then rejects it. It slams lower. It trades straight into the price range of the next bullish fair value gap, which formed on the left side of the curve. This is the bullish fair value gap which I'm referring to. this blue shaded box. Notice that during this repricing lower, a bearish fair value gap formed, meaning you can see that this bearish fair value gap formed between the price ranges of this bullish fair value gap and this bullish fair value gap between the blue shaded boxes. We see the market retrace into that CB, buy side gets offered, and notice how the bodies are respecting that range. The wicks go above it, but notice that the bodies keep on crossing inside of that range until 9:30 distributes lower. Notice that the wicks are doing the damage, whilst the bodies are telling you the story. What I want you to pay attention to is the fact that we saw two CBs get created. Meaning I have one CB annotated, but if you pay close attention to this higher CB, you can see that this CB also got created. But notice that the market didn't have to retrace into that CB before continuing lower. The reason why is because this CB was a breakaway gap. And when you have two imbalances like this, meaning you have one imbalance up here and another imbalance below it, we can monitor whether or not that higher imbalance is going to be left intact. And the way we monitor that is by determining whether or not the price range is already balanced. So that's a little gem for those of you that watched this lecture all the way until where we are currently at. 9:30 opens up and we see the market initially run higher, trading back into that BC's price range before it begins to slam towards the downside. Notice that it closes below this bullish fair value gap on the left side of the curve and below this low. Next candle opens up, offers buy side into this old low, into this blue shaded box before it slams lower once more. Notice that we displace with this CB right here and the market retraces into that CB. Notice that the wicks keep on going into that CB, but the bodies don't even cross inside of it. That right there is telling to you that it is a very bearish market and that further sell side delivery is likely going to take place next. What can we target? We are targeting the sell side liquidity resting below these relative weak lows because these lows begin the expansion leg higher into a point of interest from which we are seeing a smart money reversal taking place. What I will do within one of the upcoming lectures is I will explain market maker models to you in depth. Once you understand market maker models, you will understand where we can anticipate opportunities to present itself when it comes to where these PD arrays are likely going to form. And that is going to be a very insightful lecture. And it's either going to be the next lecture or the lecture after it. But with that being said, this lecture on institutional order flow comes to an end. During this lecture, I discussed the topics of the most important PD arrays with you. These are the PD arrays which are required to understand in order to begin looking for examples in your own charts of bullish and bearish order flow. And what I really suggest you to do is not to treat this mentorship as just, a series which you're watching just for the fun of it and you're just watching it and treating it as if it is a Netflix series or so. No, you have now watched this lecture and you have properly taken notes already. If you haven't yet, I would highly suggest you to rewatch the lecture and take proper notes. And when you have taken proper notes, I suggest you to go into your own charts and look whether or not there's any validity behind the things which I'm mentioning during this lecture. It doesn't take long for you to realize that these algorithmic signatures are in fact hidden in plain sight. So with that being said, I hope that you found this lecture insightful. I look forward to catching up with you in the next one and I wish you all the best with your studies. Be safe.